This week on the Retirement Quick Tips podcast, I'm talking about gold. Is it a smart hedge or a bad investment? And today I want to focus on some of the dynamics that really drive gold prices. And starting with the myth, though, that gold is a hedge against inflation. Now, that's a good place to start because that's what you hear all the time. Every time gold prices spike, every time you hear advertisements for buying gold, people tout that it's this inflation hedge. And you may have even repeated that yourself. I certainly have. But what's interesting is that gold as an inflation hedge doesn't have a long history. The price of gold up until I believe the late 1960s had only changed like 3 times. Like it was a fixed price for a long time, decades. And so gold didn't really fluctuate or change that much until we went off the gold standard. And then around that time, it was able to start kind of fluctuating and moving up and down like anything else. And so you may have heard that gold is an inflation hedge, but we don't really have that many periods of higher inflation to say, oh yeah, every time there's inflation, gold tends to do well. And in fact, the most recent time that gold actually didn't do well at all during inflation was the most recent bout we had post-COVID. So when inflation was really spiking in 2021, 2022, if you look at the price of gold during that time, it kind of went nowhere. It bounced around a little bit, but if you were to buy gold in 2021, even a little bit after inflation started to perk up or you got the whiff of inflation, like, oh, I'm going to go out and buy some gold because inflation's heading higher, it would have been a bad investment. And you would have lost money in some cases, depending on where you bought. I just looked at the price of gold. If you bought it like at the very end of 2020, when inflation, I was talking about inflation on the podcast in 2020, so it wasn't a surprise. But if you do that and then pull it forward all the way into mid to late 2022, when inflation was at its highest and before it started to come down, if you had invested in gold over that time period, you would have lost like 12%. So it's not a very good historical correlation with inflation because we also had periods of much lower inflation where gold actually did just fine. So as I mentioned earlier in this week, it is more of a hedge against economic uncertainty more than it is a hedge against inflation. So let's talk about some of those factors that influence the price of gold because they are many. And that's why I think gold is not so easy to understand. You could take the simplistic view that when the world is an uncertain place, which is honestly all the time, but when it's particularly scary, gold tends to do well. And that is true. But as I opened this week with a quote from Warren Buffett, when you buy gold, you better hope that things get scarier and things get worse off because that's how you tend to make money in gold. Things have to get worse from here, at least the point you buy gold in order for it to do well. But that's not the only driving factor. So one of them is just the supply of gold and mining production. I talked about how gold is a commodity, so primarily supply and demand are going to impact the price of gold. But it's kind of a unique animal because there's a very limited supply of gold around the world, and it doesn't change that much because new gold production or, supply of gold every year is pretty small. Another big influence on the price of gold is central banks. Are they buying gold? Are they selling gold? Central banks around the world are the biggest investor in gold. They own collectively about 20% of the world's gold. Whether or not central banks around the world, whether it be even in the United States, Europe, elsewhere, if they're buying or selling gold, that obviously because they're selling large portions, it's not like your grandma selling some jewelry down the street. They're selling these huge portions, and so that drives the price of gold. And so what they're doing, whether they're buying or selling, can make supply more available or less available and have a huge influence on the price of gold. Because again, since gold is a commodity, that's important to understand. It's mostly supply and demand, who's buying it, who's selling it, and why that has a big influence on the overall price of gold. So one interesting reason why gold has a reputation as an inflation hedge is because gold, like many other assets around the world, it's denominated in dollars across the world. So if you are in Europe and you're wanting to buy gold, its price, it actually tends to be pegged somewhat or based in whatever the US dollar is. So when the US dollar goes down in value relative to other currencies around the world, then gold actually becomes cheaper for foreign buyers. And so they tend to gobble it up more. It's cheaper compared to what it was maybe 3, 6, 9 months ago. And I think that's a big reason why gold prices have gone up so much recently, is because now that the dollar is weakened compared to what the gold prices used to be when they're translated from the dollar denominated world market, it's much cheaper. It's much more attractive for many of these foreign buyers to then step in and say, ooh, yeah, I'm going to own some gold, especially because stocks aren't doing well. There's a lot of foreign ownership in US stocks and in treasury bonds, but if the attractiveness of those assets, real estate, not all that attractive right now, that's kind of frozen too in the US. So it's only natural, I think, that gold would gobble up some more foreign investors. And that could be a big reason why we're seeing gold go up so much right now, even without the spike in inflation that tends to be correlated, or it tends to be a reason why people say, oh, you should buy gold because of inflation. Well, no, not always. I think another reason for the consistently better returns that we've seen in recent years in gold compared to maybe the 1990s or 2000s, where you saw long periods where gold declined in value or wasn't stable at all, is simply because now investing in gold is much, much easier than it used to be. You used to be able to you could buy gold coins and bars and things like that. Buying the physical gold is a headache, but now you can buy ETFs, you can buy mutual funds, index funds. There's lots of ways to invest in gold without the headaches of owning the physical assets. And we saw this last year with Bitcoin when you could buy a Bitcoin ETF. The price of Bitcoin soared because now it's accessible. You can trade it just like you could a stock. And you didn't have to mess with all the weird things with, what are they called? The locker, storage lock? I don't know. But yeah, it's very similar with what happened with Bitcoin last year. But I think, that was a sudden pop you saw in prices when you could buy the Bitcoin ETFs. Whereas with gold, as more ways to invest in gold come to the market, these funds have been established for many, many years now. It's just easier to access gold. So I think the general demand for gold made much, much easier through buying it in like a mutual fund or ETF has also helped to buoy gold prices in recent years. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.